If I inherit stock or brokerage assets, do I owe taxes right away or should I sell immediately? Imagine you inherit a brokerage account containing stock that a parent purchased decades ago. They may have paid $1,000 or $10,000 for it, and today it's worth $100,000. Naturally, your first thought might be, did I just inherit a $90,000 tax bill? Usually, the answer is no. Simply inheriting stock or brokerage assets generally does not create an immediate federal income tax bill. And in many cases, inherited investments receive one of the most valuable tax benefits available under current law, a step up in cost basis. Your cost basis is essentially the number used to determine how much taxable gain or loss you have when you sell an investment. Normally, if somebody buys a stock for $10,000 and later sells it for $100,000, there's a $90,000 capital gain. But when you inherit a stock, your basis is generally adjusted to its fair market value on the original owner's date of death. So, if the stock was worth $100,000 on that date, your new basis would generally be approximately $100,000. The original $90,000 of appreciation would not ordinarily become your taxable capital gain. Now, suppose you sell the stock a few weeks later for $102,000. Your taxable gain may be only $2,000, which is the growth that occurred after the date of death valuation. The same concept can also work in the opposite direction. If the stock was worth $100,000 on the date of death and fell to $95,000 before you sold it, you may have a $5,000 capital loss. This is why the first number you need is not what the person originally paid for the stock. The first number you need is its official date of death value. And this is also where people can make an expensive mistake. Inherited property and gifted property do not generally receive the same tax treatment. If someone gives you an appreciated stock while they are alive, you will often receive their existing cost basis. But if you inherit the stock after their death, the basis will generally be adjusted to its date of death value. That distinction can represent tens or even hundreds of thousands of dollars in potential taxes. So, should you sell inherited stock immediately? Maybe, but the answer should not be based on taxes alone. Once the basis has been adjusted, selling shortly after the inheritance may create very little taxable gain. That can make it an unusually good opportunity to reposition the assets at that time. For example, you may inherit a portfolio that is heavily concentrated in one company. Perhaps your parent worked for that company for 30 years and accumulated a large amount of its stock. That investment may have made sense for them, or it may have simply been something that they never wanted to sell. But you did not inherit their financial goals, their income needs, or their tolerance for risk. You inherited the investment. These are not necessarily the same thing. So ask yourself a very simple question. If I had received this inheritance entirely in cash, would I use all of it to purchase these exact investments today? If the answer is no, that's a strong sign the portfolio deserves another look. Selling may allow you to diversify, reduce risk, create an emergency reserve, pay down debt, fund retirement, or reinvest the money around your own goals. On the other hand, you should not just sell everything automatically because you inherit. The account may already contain a well-diversified investment that may already fit your plan. Selling could also generate gains if the investments have appreciated since the date of death. And mutual funds or other holdings may generate taxable dividends or capital gains distributions even if you do not sell them yourself. The right move is usually to slow down just enough to gather the correct information. So first, confirm whether the assets were truly inherited rather than gifted. Second, obtain the date of death valuation and verify the brokerage firm has recorded the correct cost basis. Third, review how much each investment has risen or fallen since that date. And fourth, look at the entire portfolio, not just the inherited account. You may already own the same companies or funds elsewhere, creating more concentration than you realize, and that's important. Finally, determine what the inheritance is supposed to accomplish. Is it retirement money, a future home purchase, a college fund for children or grandchildren, money you want to preserve, or money that gives you permission to make a major life change? That purpose should help determine how the assets are invested. And there's one more important distinction. This conversation applies to inherited stocks, mutual funds, and other assets held in taxable brokerage accounts. Inherited IRAs, 401ks, annuities, and certain other assets follow completely different tax and distribution rules. Do not assume the step-up in basis applies to every account simply because it was inherited. So, when you inherit a brokerage account, you usually do not need to panic about an immediate income tax bill. But you also should not leave the account untouched for years simply because those were someone else's investments. Confirm the basis, understand the tax impact.